What's up, guys? Roger and Norv back again. Thank you guys so much for joining us. We have a lot to cover today. We have a lot of statistics we're going to go over as far as home prices, values, predictions, where they're going, what the year over year appreciation is, what it's predicted to be. And we're going to talk a little bit about the last video we made about it switching to a buyer's market. We're going to talk about ARMs a little bit, and we're going to talk about inflation. So Norv, kick us off with some stats on appreciation.
Hey, so what's going on, guys? Definitely some crazy numbers, but so year over year, Case Schiller index came out today showing a 19% appreciation year over year, January to January. So, obviously that number is huge and something that we all expected for the year for 2021 coming into 2022. So that came out today. Obviously, lots happened since January, so it's going to be interesting to see where we end up going forward. But that number is over 19% year over year, and Arizona and Florida led the country and the most appreciation. I think they're over 30%. Phoenix specifically, Tampa, Miami over 30% year over year. So that's never before numbers in 1 year, right? 30%. Consistently, like you were 15, 20, and then 30 last year.
Crazy appreciation. So if you bought in Florida or Arizona, good for you. Tap yourself on the back.
For sure. And then so other than that, and Zillow, we had Zillow predicting another 18% appreciation for the February through February of 2023. So for the forward year, Zillow's predicting 18% appreciation. So that's pretty interesting with this environment for them to come out and say that. So, obviously there's a lot of liquidity out there. The market's still looking pretty strong. So it's not very far-fetched. I think they're onto something,
The big thing is supply and demand. I mean, when it comes to the price of anything going up, it's all comes down to supply and demand. And there are going to be other factors, right? Like we talked about rates going up, that's a factor. But I think the biggest statistic that's affecting these home values that we're going to talk about right now is supply and demand. Bottom line, end of the day, that's the biggest factor why it's gone up 30%, 20, 30%, and it's going to continue to go up. So right now, Norv, tell us a little bit about homes on the market, how many there are, how many buyers there are, and the imbalance there.
Sure. Big time imbalance. I think 1 in 5, one home for every 5 buyers out there is the number. So we have 870,000 across the nation homes for sale. That does not include another 35,000 in new homes that are out there in the market ready to move in. So that puts us at a little bit over 900,000 total homes in the market and we're undersupplied by 4 million homes. So that means 1 in 5 will get a home, but the other 4 are still looking.
Yeah. So 5 million people right now looking to buy a home. From those 5 million people looking to buy a home, there's only 905,000 homes for sale. So less than 1 million. So that is the huge imbalance. It's all going to come down to, are more homes going to hit the market? Are builders going to build fast enough to keep up with this demand? So crazy numbers, way skewed. You got this many buyers and this many sellers. That's why home prices are going to continue to go up. That's the biggest factor. Unless that changes, continue to expect appreciation to go up at a crazy number, no matter what rates are. So wanted to talk about that a little bit because the last video we talked about it shifting to a buyer's market. Potentially, we could be in the very beginning stages. The one clarifying statement I want to make is, because we're not here to make any crazy headlines and just throw a bunch of BS out there, right? That's not what we're doing. It could be the beginning of a shift, right? So the supply and demand is a huge issue, right? That's the bigger issue than rates. But with rates, it could be the beginning. And the example that I want to compare it to is inflation, right? We printed a lot of money over 18 months during the pandemic, right? But gas prices didn't go up overnight. It takes years for that to seep into prices of everything, right? For the inflation to hit, it's going to take time. It's going to take a couple of years. Same thing with the rates. Rates are slowly going up. again, we still think it's going to reach 6-7%. And that will slow down the market a little, but it's going to take time, guys. It's not like rates take a jump and then the next week you're going to have no offers on your homes. Okay. That's not what we're saying. So I just want to clear that part up.
Yes, sir.
And yeah. So Norv, what else you got for us before we jump into a couple other things?
We're going to talk about ARMs in a little bit.
Yeah, ARMs. Let's get into ARMs. So adjustable rate mortgages. So, you know, adjustable rate mortgages weren't even a thing over the last 5 to 10 years. No need to, because you're getting a 30-year fixed at 2.75, 3.1%. But now that rates are higher, you may want to consider an ARM because you're going to get a lower rate for the first 5, 7, 10 years. And Nora's going to tell us what the advantages of ARMs.
For sure. So the advantage of an ARM is you're getting market below pricing, right? You're getting a rate in the high threes right now. We just priced out a couple jumbos on an ARM, and we're at 3.875 to 4%. So with that being said, we know where rates are on conventional. So on a conventional jumbo, you'd be at 4.5, or a jumbo. Conventional, about there, a little bit higher. So jumbos have become a little bit more competitive. I feel like has slightly better pricing than conventional pricing. And that's sort of how it's always been, but a little bit more of a gap there now. But the ARM gives you that advantage of being in the high 3.875, high threes to 4%. So you do see some savings there, potentially save $500, you know, $500 plus if you're in that jumbo category a month, based on that half percentage lower. So you factor that in, $6,000 a year, 7 years out, $42,000 difference. Now,
I'll take that.
That's $42,000 in your pocket, right?
I'll take it.
Phenomenal. And here's why I think it's a good bet. It's where you want to be, because it puts you in a rate range of where we are psychologically kind of and most clients want to be. They hear 4.5%, 5%, sort of freak out. Although historically speaking, it's pretty good overall. But we're psychologically used to 2 and 3, so it can put you in your comfort zone. And then the other point of emphasis on this is that these opportunities to refinance lower are always going to be there. Whether they're every 10, 15 years, we know that in the last 20 years, or rather 15 years, we've had 2. So if you're in a 7/6 ARM, chances are in the next 7 years, you might have another opportunity. That's a pretty good likelihood.
That you're going to refinance.
That you're going to refinance and be able to get into maybe a 30-year fixed at a similar rate with a, you know, get yourself out of the ARM at that point while you've maintained the savings. If you're saving $6,000 a year, even if you just save for 1 year, let's say that opportunity comes next year, probably not likely, but if it were to, you still save money. So I think when it comes to properties and my clients, the conversations I've had in the last week with them has been that, you know, the focus should always be the property, the location, the foundation, the guts of the property should always be the focus. And that is where you're going to get most of your value. We always freak out about rates, but one thing that's certain about rates is that they move around and opportunities will be there. So that payment is not fixed for 30 years. And so you'll more than likely have another opportunity. And if a rate in the 5s is not it's gonna put you out of your affordability range or maybe your comfort zone, this is a good option, knowing what is out there in the future and the possibilities that would be out there for you to refinance lower. So I think
that's a perfect transition, because I'm going to break it down. So right now, basically on an ARM, you're getting 0.5% to 3/4 better than a fixed. Okay. And it's fixed for 5, 7 years. So you're saving tons of money over the next 5 to 7 years. And what's going to happen is once Fed raises rates, inflation gets under control, what do you think is going to happen next? They're going to lower the rates back down. I'm going to show you guys a few examples. If you don't mind, I'm going to pop in here and show you guys examples of times where that has happened and where you can get into an ARM. And we're likely over the next 7 years. I don't know who's going to watch this channel and refer back 7 years later, but feel free to save this video and come back in 7 years. But I mean, I don't know about Nor, but I can pretty confidently say that in 7 years, at some point, we will come back down in the low 3s to high 2% range. And I'm going to show you guys some examples. But Norv, what do you think?
For sure.
Yeah,
I agree. I couldn't agree more. That's exactly the mindset that well, we're used to, right? Because we've seen these things. We've
yeah,
seen rates go up and come down, the market kind of changing. And this, because of like the inflation, fears that we have now and the environment that we're in, being so crazy and out of control, doesn't mean that it's going to last forever and that rates are going to go up continuously. They will, but at some point, there's going to be a balance happening. And whether there's, whether we get pushed to the brink of recession and there's a sell-off in the market and, safety play into bonds, that could naturally kind of bring things down too. So it's not just about the Fed. The Fed is using tools to slow down inflation, but the market has a way of kind of dictating where things need to be. So if things slow down fast enough or too fast, you might see like potentially a recession happening, right? And there are indicators out there about, the economy sort of potentially not slowing down, but there's signs that we may be kind of, that a recession could be out there in the horizon.
yeah.
Now, we're trying.
That's. I think we've been hearing that for a long time, and it eventually has to happen. And recessions are good. Recessions balance things out. Recessions get rid of the bad players, right? Get rid of the bad apples. So it's a good thing. So if we look back at history, okay, can you see my screen here?
I can.
Okay, great. So here, 1970s, Arthur Burns was the Fed chair. He ignored inflation, which was rising rapidly. By the way, if you guys want to see a little more detail on this, I made another video, 2022 forecast. I'll link it below and I'll put it at the end of this video if you guys want to see more details on this and what's going to happen with our overall prediction. But he ignored inflation. Year over year, inflation ballooned from 7%, which is already high, to 14% in 2 years, from 78 to 80. Okay, inflation doubled. He continued to say that it's transient, and then what happened? Rates went from 12% to 18% for mortgages. Okay, so that was in the late 80s.
Can you imagine how fast property prices were going up for mortgage rates to go to 18 to 20%? Like, at that time. And so it's like, it's a recipe. Sorry to cut you off. I know you're going off there.
Yeah.
Good stuff. But that number, that 12 to 18%.
Well, here, let's see what happens. Okay. So 1980, Paul Volcker comes in. So he's going to fix inflation. He raised rates from 11% to 20%. So if you think about it, if you compare that, and I know it sounds crazy, a mortgage at 11% or whatever, or 20%, just imagine today rates from
federal funds it.
Yeah, going from 3% rates to 6%. That's not that crazy. And that's what we're predicting.
Mm-hmm.
After he raised rates in 2 years, slowly over 2 years, he raised it. Inflation dropped. Inflation dropped from 14% to 5%, got it back under control. That's what the government's doing now. And then because inflation dropped, mortgage rates sharply declined from 18 to 12%, is exactly tying into the arms that we're suggesting you might want to consider getting into an arm, because again, as we've seen in the past, the Fed raises rates, gets inflation under control, and then the other side effect, rates go back down. So rates go back down. Again, you refinance into a fixed rate after it drops. Some of the consequences that the S&P sharply declined by 30%, and then the tighter money policy pushed us into a recession. Again, like we just said, that's where we're headed. We're predicting. So guys, history tends to repeat itself, that we're in the same situation now. There's one other example really quickly I want to share. Again, same thing happened when Alan Greenspan was Fed chair late in the 90s. Inflation doubled from 1.75 to 3.5%. I mean, I think we've more than doubled. We've maybe tripled or quadrupled during this time. It caused rates to go from 7 to 8.5%. So inflation went up 1.75. He raised rates about 1.75. He took action immediately before it got out of control, right? So Alan Greenspan stepped in real quick and did the same thing, raised rates, got inflation back under control, and rates went from 4.75 to 6.5 in a year. Okay. But because at that time it wasn't as crazy as now, right? Like what we're seeing now is a much crazy scenario. He got it under control early, but it's too late. We've printed the money. We're going down this rabbit hole. Inflation dropped from 3.5 to 1%. So again, raise the rates, inflation drops, mortgage rates drop from 8.5 to 5.5, sparking a refi boom. So guys, it's the same
at
thing.
5.5.
It's happening over and over again, as we've seen in history. Again, consequences where S&P fell 50%, US entered into a recession. Recessions, again, we can agree are good because they're going to flush out the bad and start fresh, right? It's sow the seeds for a new beginning, right? Every recession sows the seeds for a new boom, and every boom sows the seeds for a new recession. So nothing to be afraid of. If you've taken care of yourself financially, you've put some money aside, you've made the right investments, nothing to fear. It's actually going to only bring more opportunity. Can you imagine if FANG stocks dropped 50% right now? What a great opportunity that would be to pick some of those up.
For sure. And like looking at this, I think the bigger picture from these points here from the Fed chairs, the past Fed chairs, like, so this was late 1990s, the Greenspan era, and then Volcker was in the late 80s, right? Can you click on that Volcker one again?
Started in 1980.
1980. So from 80 to now, we're talking about 40 years. This is when inflation dropped, rates dropped, right? Rates dropped, mortgage rates dropped from 18% to 12%. So we had a 33% roughly decline in mortgage rates, which would also mean your payment would be that much lower, right? Approximately, if rates are lower, based on the interest that your mortgage would have on that. So that's 40 years. Then Greenspan was early 2000s. That's 20 years. And then we know what happened after that.
We're 20 years again. I didn't even see that, but look, we're 20 years again.
So in just the last 20, forget going back to Volcker, from 2001 and during Greenspan, we saw a huge refi boom. That's one. 2009, 2010, 11, we had a major refi boom, right? And then just this last year and a half, 2 years, we had another refi boom. And so that's 3 in the last 20 years. And that's why and if you factor in a 7/6 arm, I think that puts you in a pretty good space. Historically speaking, like these things tend to happen every 7 to 10 years.
Yeah. About
7 years. So these ups and downs and how the market kind of takes off, especially after like monetary policy. And there's a Federal Reserve steps in and prints a lot of money with inflation. It's almost the same. It's the repeat cycle. Yeah. And give it, like, if I were in the market these days today and I'm looking for a property, I'm looking at this saying, well, yeah, 30-year mortgage is great, but why am I taking that 5% right now, or that 4.75? I can get into 3.8 or a 4% on a 7.6 and feel just as good about it, knowing that, I'll get another opportunity to refinance lower. And if you're looking to be more cautious, then you take the 30-year. But knowing how many times we've had these opportunities, I think I would take the chances there and put myself in an adjustable, lower that payment, save $42,000 at the very least.
That is not a small chunk of change. That money just think about it like this: the money that you're saving there, once we go into a recession, you invest that money, and that money compounds over time, right? Like, these are the moves that put you above everyone else, create that financial security. But you know what? At the end of the day, it takes guts. Like, you have to see this stuff and have the guts to take the action, because you could look at this stuff all day, right? We could talk about this day in and day out. But if you overthink, or if you listen to your freaking neighbor who's doesn't know one thing about mortgages, inflation, the history, economics. You're listening, you know, who are you listening to, right? Are you listening to people who are into industry? Are you listening to experts? Are you doing your own research and making your own decisions? I think a lot of times it comes down to mindset too. Do you have the guts to pull the trigger on something like this? You know, so
But you
hopefully
just have to know your options. You have to know your options, and you have to know why. And I think aside from just like these opportunities being there every like so many years, several years, right? I think the other thing people don't factor in a lot is they buy a home maybe when they don't have kids, they're just newlyweds, right? And then, or they buy a home when they have their first kid, or now they've had their third kid and they're kind of a little bit, you know,
outgrown
they've
the
moved.
house.
Yeah, they're running around. Kids are running around the house. And what happens to these people as 5 to 7 years passes by? Kids get older. You have more kids. The kids move out. You're downsizing. You have, you know, and so where you're newlywed and you're starting to have kids, you're probably maybe you didn't think about the school district that you were in. So these things start to become a factor. And so all of these people end up having to move into a different pocket because of school districts, because they have to upgrade to add more rooms, downgrade. And so other than these opportunities, I think the other thing most people discount is the changes in life and then how your needs change. And that's also another reason why most people don't stay in a mortgage for 30 years, because they're always changing. Things are always been, you know, where you're moving around, you're going to a better school district, you're downsizing, kids are off to college, you're upgrading because you had your third or fourth kid. And so these things do play into your decision, should play into your decision making when it comes to getting a 30-year mortgage. Are you going to sit there for 30 years in that same house? Most people don't, where they move a block away to, you know, change their needs up or not. You know, that's also another factor. I think that's a pretty big one. And that's why I think a 7/6 ARM right now would be a pretty good recommendation.
Yeah. So if you're interested in getting a 7/6 ARM, whether you're refining to take cash out or you're buying, hit us up. Norv is on Instagram, Norv Home Loans. Roger, mortgage expert. If you guys are watching this and you're interested in getting a mortgage or refinance, any of that, we're licensed in California, Arizona. We just want to bring this insightful content. Again, we're not claiming to be, well, even though my tag is Roger, mortgage expert, you know, do your own research, right? Do your own research, make your own decisions. None of this is financial advice, but this is just what we're seeing. This is our perspective, and we're in it every day. Yeah, we're homeowners and we're helping people buy homes every single day. That's what we do day in and day out. So we see the housing market, we see rates, and we just want to bring some of that information, knowledge that we're seeing to you guys, bring some value. So anything else you want to say to wrap up, Norv?
No, that's it. To your point, I think that's the core of it all is we want to give them information and advice from the front lines, how we see it, and give that data over to them and this info and help make their decision-making process a little bit easier and take that stress off is our goal. And other than that, I think that's a good place to end it, I think, as far as like where we are today. The other one thing actually, no, I did want to touch on is we're seeing a little bit of relief in mortgage rates today. And, you know, mortgage rates and inflation fears specifically have been exacerbated because of the war in Ukraine. And so it sounds like they are at the negotiating table. There's some peace talks, whether they, you know, mature or not, or just kind of die out. We don't know yet, but that is taking some of the pressure off of the inflation fears that are out there. The you know, so we're seeing the 10-year there's a safety play happening. 10 years down about 8 bips on the day, which is pretty big compared to what we've seen the last couple of weeks, been just higher and higher almost every other day. So there's some relief happening there. Market's cheering that on.
Yeah, a little bit of relief in mortgage rates, little improvement. Again, big picture over the next year, we expect rates to go back up. But if you're in escrow, you may want to consider locking, or if you've been floating your interest rate on a refinance, again, you might want to consider locking. And we'll wrap up here. Thank you guys again.
Thank you, everyone.
Thank you. We'll see you next time.
All right, Roger.
Later.
Bye-bye.